the dollar index falling sharply today and down more than 2% in a week. Joining us now to explain that move and the geopolitical impact of the Trump tariff announcements is Marko Papic. He's chief strategist at BCA Research. Marko, it's great to have you back on the show. Let's start right there because historically, at least traditionally, it's always my understanding that that was the case traditionally, you would see a dollar strengthen amidst hawkish trade policy like this. Instead, the opposite has happened. Why?
Yeah, so I think that there's a second order effect that's very important, which is that when America is, mean to the rest of the world, it forces the rest of the world to kind of clean up their house. You can think of President Trump like a spoonful of that kind of a stinky, very poorly tasting fish oil that the rest of the world now has to ingest and actually stimulate domestically. China has to deal with its problem with its consumers. Europe has to integrate further. And I think that the markets are pricing that in. But I would also go beyond that and say that if you look at when the dollar peaked, it actually peaked well before anyone thought that tariffs would be as harsh as they are. The dollar peaked well before recession probability increased. And it really peaked because of fiscal policy. Fiscal policy in Congress, which no one's paying attention to right now, is not coming out the way that most investors expected. We've got Mr. Pump Prime back in the White House, Mr. Economic Populist, nominal GDP growth. And what we're getting is kind of paltry. 2017 tax cuts extended. And I think that fundamentally what's underpinned U.S. exceptionalism is, quite frankly, nothing exceptional. It's been fiscal orgy of the last 5 years, and that's coming to an end. So American assets have actually been reacting to this, not the trade war. How else do we explain the NASDAQ is down double, 6% relative to some of the countries that have been actually targeted?
Well, what would you say to the argument, Marko, that U.S. either austerity or fiscal attention is medium and long-term healthy, and that European spending on investment in this kind of thing is probably only for the short term? They won't actually do it for the medium and long term.
Actually, no, I think that Europeans have finally figured out that they do need to spend more money. And many American investors have a very poor understanding of fiscal space in Europe. No, Europe is not bankrupt. Germany has wallops of space. And because this is seen in Europe as an alien invasion, this is an exogenous shock, kind of like the pandemic, they're going to likely use EU-wide bond issuance to finance further infrastructure spending and defense spending. So I think that we will have a shift there. And I do agree with you, though, that some consolidation in the U.S. is healthy. And just to be clear, we're not talking about austerity. We're talking about a rate of change difference in the U.S. from, what was 5 years of massive fiscal outlays to a lot less. And so the dollar sniffed that out before this. Every time we have a trade news, a trade tweet, tariffs, what happens? Big tech sells off, not the things that most investors thought should sell off, which is Europe and Asia.